So tonight's topic is the bonus depreciation, right? And that's a picture of Ellen. She's our gatekeeper for all things acquisition. If we have a deal that you want us to underwrite and give you feedback, this all Ellen. She's the gatekeeper of most of the underwriting asset. So if she gives us a go, we all stop everything and listen to her. And if she gives us a no-go, then it's a no-go. So Ellen, I thought I'll share her pictures. She doesn't join with us here much, but always just want to share that we have a team behind us. We rely on our team heavily to do some of the work that we do. And as before I get into depreciation, as you all have seen today, there was a rate cut. All right, more than what we expected. Market priced in quarter basis point, and we ended up cutting 50 basis points, right? The interesting part is we have seen that coming a little bit on a different side of the business. From the residential side, we have seen some warm up on the pricing, and then that cascaded into that. So also on that note, remember, there's a lot of emotion that kicked in today. And the emotion, the ride, the vibe will happen. And you're going to hear in the news, rate cut happen. And right now, buyers are going to be here, sellers going to be here, money is going to be here. Those are somewhat of it true, but not all that true, right? You have to go listen to the news that kind of go through it. A point is, there's a rate cut today, and we're planning on a couple of more rate cuts coming up over the years. As you go, the next one should be after the election. But from the acquisition side, whatever the rate is today, and if we close a property, let's say tomorrow, within the next 90 days, even though rate changes, our rate isn't changing. So we have what we have within the next 60 days. So if you buy any asset, the rate is fixed until you refi, which is 3 years out as you go. So that's one. So go to the news. And the second thing, the 0.5 percentage point, it's really not gonna make or break any deal. That means if someone has to sell, they really have to sell, right? And that 0.5 percentage point will help a little bit, but not to a point it's going to make the project profitable on the spot. On that note, the biggest news that we had from the massive side, we have our first asset that we bought in Pasadena. It was right when the rate cut happened, which is we purchased the property at a 3.98% interest rate, or 3.89% interest rate, and we didn't even collect the first check. The rate went up about 6%. So that was the gift that we had from the feds. It was a $16,000 increase in the monthly payment, not even in first 30 days. That asset, we got the loan code yesterday that we are planning on doing a cash out refi in end of the Q1 next year. Within 5 months, it's a hard loan and it's a cash out. So we'll reset the loan with the stabilized debt with the lower interest rate, 5.4, 5.5-ish all in. So that's the first of our asset that we're able to execute the refi. So rate cut helps. It didn't make the project profitable. It obviously gave us some breathing room. So from the project side, we slipped the project by 6 months, but we're back to the 5 years plan. We're almost back to the 5 years plan by refining it. So instead of refining in this year, we're refining next year. It's about 6-7 months delay, but we have executed the project. Our cash earning is the highest amount of cash that we collected from the property. It is stabilized. Economic vacancy is very low. So even though we have executed, and on that interest rate really helped. So that was the best news, right? So interest rate helps. All right, so this Q3 and the Q4 series, sorry about the typo. So what we're gonna talk about the next quarter is optimizing income for income tax. And the first session today is understanding the depreciation and how does that work and how it's gonna help you today and how you can position yourself for next year. At the bottom of the slide, I want you and everyone to read a little bit. Understanding and planning for personal NOI has exceptional value creation for the amount of work needed. Think about that for a second. We talk about property NOI, but you as an individual, we have our own NOI as well. Taxation is tough, it's pain, it's not fun, but it's really fun when you get into it. It may take 10, 15 hours a year maybe to do that, but once you do that, you can optimize your tax planning all the time, and then it becomes more fun. So our tagline is it's not how much you make, it's how much you keep. So that's your personal NOI. So remember, you have a pro forma too, right? So think about yourself as a P&L, as a profit center, and do your P&L and calculate your NOI. And this is the time. This is September. and you have 3 months to really optimize for this year's tax. And after 2 months or so, you don't have much of a time. The last thing you want to do, call your CPA next year to fix this year's tax. This is the time you want to call to say, hey, help me out. And I have 90 days to fix my or optimize my P&L, and as you go. Okay. So as we talk about the bonus depreciation, again, I'm going to go down a little bit more deep into it. What we'll talk about the tax laws that is affecting bonus depreciation now, and some of the strategies to maximize the cash flow, and some of the tools and resources for accurate calculation that we use. And we, last but not the least, we encourage all of you guys to take action. So I'll give you one of my this year. We brought in a full-time team member to help us out on the finance side. And just because she was able to do our tax planning right, the amount of savings that we had that paid for our salary plus more. So the point is, everybody here, if you take 10, 15, 20, 30 minutes, talk to your CPA, and then have them do your tax strategy, it's going to benefit you. Worst case scenario, you don't get the benefit this year, but you're going to take an action towards the benefit next year or years to come. Point is, go talk to your CPA. On that note, with the asterisks, do not go to CPA who you pay $500 to submit your LLC or documentation. That's not the CPA who is going to optimize your income for your tax. There are CPAs, their role is to strategize the taxes, and you go engage with them. And Bill Pilkington, one of our CPAs, he does all of our work. So, but feel free to reach out to your CPA. All right, so let's get into bonus depreciation. What is it? So as a passive investor, one of the vehicles that we have is we call it bonus depreciation. It's really a tax incentive that allows the business to immediately deduct a large percentage of the purchase price of the asset. So think about a house, right? When you buy a house, straight line 27 and a half to 30 years. But if you buy some of the assets, the 27 and a half to 30 years gets narrowed down to 5 years. That means you get extra write-off, right? So that's there. Bonus depreciation, it's also known as the additional first-year depreciation deduction. That means you bonus the year one. Instead of 30 years, you get to write off everything in the 5 years. The way you can think about it, more kitchens you have, more bathrooms you have, more ACs that you have, faster you can write off, right? Sometimes maintenance of a bathroom is expensive, but guess what? It pays dividend to have more toilets and more AC and HVAC systems. It was also created as a way to encourage investments by small businesses and stimulate the whole economy. Trump really came and helped, but the Republican came and really helped on that one. And it is phasing out as of now, which is it's going away. So bank it. So there are two things. Depreciation is fantastic, and I'll talk a little bit more about it. It doesn't go away if you have it. So one thing is being able to receive the depreciation. Other thing is being able to use that depreciation to write off. Some of us we can, and some of us we cannot, depending on our job structure. But either way, it's fantastic to get it and save it. Why we target? Why we say that? In 2022, we had 100% depreciation. That means if I invested $1, I had almost $1 write-off, right? 2023 went down to 80%. That means if we invested $1, we'll get about 80 cents write-off, and that means my total write-off. 2024 this year, if we invest $1, we get 60 cents. Next year, it's 40 cents. As the year goes by, it's almost you have to invest 40% more to get the same amount of investment, right? So at 2026, it phases, it goes to zero, then it phases out. On that note, there was a rule proposed to the House about bringing back the whole depreciation. That did not go through. And if it did not go through now, it just haven't made anything. It didn't go to Senate. So as of now, there is no rule in the works that's going to come back and change the whole thing by saying that we'll go back to 100%. Our position is based on as is. We're going to have a step down 40% next year and 20% hereafter. 60% is what we have today. So bank it as much as you can, get it and save it down the way so you can use it. The beautiful thing about depreciation, again, it doesn't go away. If I get 60%, this year 60 cents lost for my dollar, and 2020 I don't get to use it this year. But in 2026, if I sell something, if I have a profit, I can trade against it. So bank it, save it as much as you can. It is very imperative for you to have it. All right, so let me show the charts on it. So I'm going rather quick, then if you guys, again, if you have questions, please let me know. And Phil, appreciate you joining. So great question, ST. I'll come back and answer that question. So if you look at the chart perspective on a single line depreciation from this side, it's just straight line. If you spend $100,000, just like buying a single family house. So what happened is if you do accelerated depreciation, it collapses. It takes that loss and it kind of brings it forward. So year one, you get a huge one. Typically, you get 50% off available depreciation, then it kind of goes down. So that's the beauty of it. You take a straight line and you go down this way. On the typical residential, you don't get it. But if you have a large residential over $1 million, it start making sense. And on the depreciation side, because we have a cost that we have to incur to do the go through the process, it's about $5,000 to $7,000. So amount of depreciation you can get versus the cost, it started to make sense once you hit $1 million ish or so. But on an apartment side, on a commercial side, we buy quite a bit larger asset, 5, 10, 20, $30 million. So it makes a lot of sense. So, and this is what the benefit comes about. Right? So how do we get it? The process of getting it is called cost segregation. So this is an IRS approved process of accelerating the depreciation for real estate assets. Number two, it's like really typical building can be over 27 and a half years or 40 years, but we can compress that in this way. So that's the beauty of a bonus depreciation that we get, or someone calls it, or sometimes we call it accelerated depreciation. So you can really accelerate the whole depreciation from 30 years to really on the first 5 years. Okay, that's a little joke. Don't wait. So this was us. Don't wait on it. It's not, as of now, we don't know whether it's going to come back or not. So act like it's not coming back. And if it does come back, then it's fantastic. We get some extra bonus on top of that. Because what's going to happen is, let's say it comes back, right? That they're going to say 60% goes to 100%, so you get the 40% bonus. But let's say it doesn't come back. You still have more. So as usual, do the downside protection and upside will happen. And that's going to be a bonus as you kind of do that, right? Okay, that's on the cost seg. Let's bring the cost segregation and the depreciation put together as an example case. So at the very beginning, I was mentioning that we have the Horizon. And that's one of our multifamily property in San Antonio. We bought that in February this year, and we operate that. We're going through the value add strategy, and we're at the tail end where we finished the exterior rehab. We finished the almost done 80-90%. We're done with interior rehab. We changed the culture a little bit, and now we are on that cusp of getting to the stabilization part of it. So question is, how would that fit in if someone invests $100,000 there, right? So on the right side, that's the example. The way we optimize for taxation is that every $100,000 invested in that property, you get $72,000 of paper loss. Roughly 39,000 loss we can realize this year, and the remaining one within 4 years gets 33. So that's the depreciation, the part. How this is the real case study. We went through the cost segment, the cost segregation. We paid the $7,000. Then the study said we can get a little bit more than 60%. So we'll end up realizing a 72% loss for that property. So if you, another way, if you're a business owner, your gross income is, let's say $1 million, and your taxable income is $300,000 or $400,000, what do you do? And you have your spouse is a real estate professional, then you can invest. And guess what? If you invest $500,000, you get almost $400,000 to write off. Then your taxable income goes down to very low. So not only you get a 20% return on your money, but also on top of that, you have $300,000 of extra money from the government at 0% that you get to reinvest. So that's the beauty of it. So this is the time we get all of our friends to call us by saying that, hey, I own the business. I looked at my gross potential income. I need to reduce that. let's go find a way to kind of place it. So that's one of the live case study for, I mean, not case study, live example of what the investment look like. So let's say you are in a place, you talk to the CPA, CPA says you should go spend some money, invest to reduce your taxable income. Then you need to do it to go find a project or find a team that you want to invest with. And then you look for a project that they have, and then you have to manage the execution risk. That means that if I were to go find a project with the team, not only I have to like the team, but also I have to like the way they underwrite it, they operate it. Let's say all things checks out. Then the last thing is, do they have a deal that they are going to close before the year ends where I can place my money? So that is the risk you have to manage in the next 90 days as you go. For in this particular case, we already own the process, so that risk goes away. All right, so I'll stop here for the depreciation side. This is my this is our pause point, and let me see. And before I go, we'll get Phil. I'll get you in about 1 second, and there's one more question I want to answer that. Then I'll introduce with one of our dear friend. SD was asking a question. No. The answer is no. If you have a, again, I'm not a CPA. I'm just sharing from what I know. Please consult with your CPA. So there, the limit is not 25K. A limit is a percentage, a 3 percentage point, and then it goes two ways. It's who we are and how we are set up. If I have a W-2, then I have a limit. May or may not be 25K. And if I have a W-2 and I'm married, filing jointly, and my spouse is a real estate professional and she checks the definition out, then that limit goes away. It becomes 100%. So when I was working at Shell, my wife left Exxon, and when she turned to Exxon, she was home. She was helping me with the real estate business. Then she turned. She got that real estate professional checkbox. Once she claimed that, our loss opened up. And then all of a sudden, we're able to write off 100% depreciation. So more you actively you play, more you get to write off, right? So that's one. At the same time, I have been through an exercise 2 years ago where I had some windfall and I wanted to execute the dollar, and I had the plan ready to execute. I had the project ready to execute, but the project could not close in December. It slipped over January. All of a sudden, I had a huge tax bill that I had to foot, right? So the planning and the execution risk are real, right? Awesome question. The question is, if investor invests capital, does all the appreciation goes to investors and or the sponsors? We split everything 70-30. So 70% of the depreciation goes to 100% of the LPs, and 30% comes to us, with an asterisk. If we have a friend, I mean, sometimes we get into a scenario, we have someone said, hey, Shirar, I have $1.5 million, $1 million. Can you give me some extra depreciation? We said, that's fine. If you have a large amount of money, then we'll give some depreciation from our end of it to make their project, so their investment hypothesis right. But usually it's a 70-30 split. We split 70-30 that way. And but sometimes there are some scenarios we'll work with you to make sure that your investment hypothesis works out. We don't do it for everybody. That's because it becomes a paperwork heavy. CPA has to do a lot of reconciliation on the back end. So we have to put you some different buckets, do some extra additional work, and CPA has to go deal with it every single year. That paperwork, that extra work, to mitigate that, your investment check, your investment size needs to be a little bit bigger than the standard size of $75,000 or $100,000. Good question. Thank you.